This episode of Talk Your Book is proudly brought to you by Honan, providing a complete range of insurance, risk, and financial solutions.
Fundies called me up, told me to take a look, but stay stubborn as bulls and talk their own book. Get the money, get the money, get the money.
Well, Andrew Chapman, thanks very much for coming back on Talk Your Book. You've been on Masters of the Market and Talk Your Book, and you're certainly a crowd favourite, so appreciate your time.
No problems, Chris. Thanks for having me back.
Now, you wanted to talk about Bard Life Sciences as your first stop. We've got a double header with you today, which, given you're in such electric form, we figured was only fitting. But before we get into Bard Life Sciences, up 600% in a few days in mid-Feb, and merchant owned it, about 14.5% of it. On a scale of 1 to Michael Mancini from Melrose Place, how smug are you feeling at the minute?
That's a generational joke.
I might isolate all the Bitcoin viewers before we've even started.
Mate, most of your listeners won't even know what we're talking about.
It has been an epic run. You must have had a very enjoyable February.
Yeah, look, we did. We've had a pretty good run, actually. We've had a couple of biotechs that have been pretty good for us in the last 12 months. The last one that I talked about here on Talk Your Book, Race, has also been a good one. We're still in that. Bard, I think, look, that news flow was phenomenal, and the market reaction was incredible. And I think, look, it's one of those ones where, we're pretty happy. We're going to print, assuming the market holds for the end of the financial year, we'll print some pretty big numbers in the Opportunities Fund this year. But look, I don't think that reactions was overcooked. I think, the market price has dropped back from it hit $5 intraday and dropped back to about $4, and now it's hovering around $3. And I think there's still plenty of opportunity to see it at least get back to those highs.
So we'll get into Bard and what they do and what those test results were in a minute. Maybe start with telling me a little bit about the history and how Bard Life came to be the entity it is today.
Yeah, it's actually a good story, Chris, because it's about 3 years ago that we started, on the back of the success that we had with PolyNovo and a couple of other biotechs. And then from PolyNovo, we sort of went into the medical cannabis space, and I still think that's got room to move, and we'll probably see some pretty decent, results coming into that space as well, still to come as it gets legalized and whatnot. But we used essentially the success of PolyNovo then to really go about looking for the next opportunity that we thought was available. And the diagnostic space was a real fragmented one. So we had a bit of a look around in that section of the market. Now, essentially, the diagnostic space, as you know, is basically just a test that would be normally quite evasive for someone. It's changing it around to be a blood test, and in really simple forms. And the blood test then, and what we did was we sort of did some research, and we came across Bard 1 and we came across Sienna. And then through that process, we completed a placement into Sienna, and we completed one into Bard 1 as well, because, and at the same time, we also were heavily invested in Rhythm, which is another biotech, RHY. And then privately, there's a fourth one in the mix, which is coming through to IPO now, called BCal. And why I did this was I took strategic stakes in all four of them with a view that we would try and get them all together and create one, really large diagnostic company in Australia. And that would be the market leader and be the biggest in Australia, the biggest listed company. And through various, reasons, that didn't quite pan out. And it was a few years of work. But what did pan out was we were able to get Sienna and Bard 1 together over a course of the last year, and that's culminated in the last probably 6 months. There've been one company called Bard 1, and the reason why I tried to put them all together is because we took the view that the diagnostic space, with a lot of biotechs actually as well, it's the same, is that you got to have multiple shots. You don't want a binary outcome, and if you've got one test and something doesn't go right, it's quite binary. Your stock can go from $1 back to 20 cents in a heartbeat. And so by trying to roll them up, what we were trying to achieve was to basically corner the market. So if you think about the body, we were trying to get, so you had a test basically from here all the way down to your knees. In that company, there would have been a test for every different type of cancer. That is, it was a broad-based big market. And as I said, for various reasons, we couldn't get it all together, but we ended up with BARD1, and over time we sold out of our holding in Rhythm, which has done really well also. And BCal now is about to go to market, so they just raised pre-IPO money, and I think that'll be a pretty hot float as well when that comes on. So we've made money regardless, but the broader plan was to get them all together, but we didn't end up there. But so be it. So we've ended up with Sienna and BARD1 coming together. And then we participated in a placement, share consolidation, and those sort of things and whatnot. And so we ended up with a really decent sized stake, and we're still sitting on that. We've trimmed a little bit through this boom in the last week of February. We trimmed a little bit off, but we're still sitting on our original stake. Actually, we just went back up yesterday, yesterday we just went back up. So as we bought some more stock into the fold. So that's how it all came about. And I think, like PolyNovo, I think this industry probably has the potential to be a billion. There's going to be $1 billion plus market cap diagnostic company somewhere along the line for sure.
And talk to me about why a blood test for cancer is such a significant improvement on traditional diagnostics for cancer.
Well, look, the accuracy is the main reason. And it's really interesting, actually. I don't read a lot of podcasts and whatnot, but apart from your own. But
of course, Chappie.
Look at one. I was listening to one the other day on Freakonomics, and they had one called "How to Fix the Incentive in Cancer Treatments" or something along those lines. And it's a really good podcast to actually get a bit of an understanding of the diagnostic industry and what we sort of looked at is what the diagnostic industry is looking to do is how to take a test that is quite invasive and a lot of the times inaccurate and streamline it to be something that's more effective and less invasive for the population. So you get more people screened versus less. And that's the reason sort of that we've been into BARD1 and all the others actually from that point of view.
And there'll be a lot of viewers here that look at total addressable market as a big part of their investment universe when they look at companies. I mean, the total addressable market for this is enormous. Maybe talk us through some of the numbers around that you've fleshed out, and maybe just some of the internal numbers, perhaps what the market cap is of BARD, to give investors a feel of the opportunity available. Yeah,
look, I think there's and this is sort of goes back to that point earlier about trying to roll up all these diagnostic companies, because there are the addressable markets within BARD. They're gigantic. They're telephone book numbers. They're in the billions, and this is where we wanted to sort of be, because if you're going to have multiple shots at it and multiple shots on goal, for instance, to use an expression, then you want to have those directed in where there's the biggest bang for your buck. And this is what I really like about BARD, because at the moment, and this is notwithstanding that there's more stuff coming down the pipeline, we sort of worked it out. There's about 9 different tests all up. And whereas some of the other diagnostic companies, they might only have one. And for my dollars, in terms of the investment money that we look after, then, that one test, it might work, in which case that's fantastic. But I'm sort of keeping in mind a little bit of risk management. And so I'm going, well, I'd rather have 9 shots at it, because, 3 or 4 will work, 1 or 2 won't, and the rest will be sort of, average. And, but the 3 or 4 that'll work, the addressable markets are gigantic. So BARD's got a market cap of about 300 mil at the moment. Now, when you look at the nearest competitors on a global scale, 300 million is pocket change in comparison. So you're talking about market sizes and company sizes that are, their major competitor in the US, for instance, is up around 11 billion. And now you start, building on the success of the results that have been released in late February. And once you've got that platform right and you start rolling that out across various other tests, your size can be massive. And this is why I think, BARD is probably, on the cusp of being the billion-dollar diagnostic company in Australia. And it's fully funded for the foreseeable future. There's no real need to raise any coin. They've got 8 million in cash, another couple of million in options that'll be exercised. So you're talking about a $10 million, cash box, which, with the current cash burn, that's pretty decent. That's a fair amount of time. And the synergies that have been created from merging those two companies is probably $1 million a year as well. So I think Bard is, even though it has had a run, and when we talked about doing this Bard on the podcast today, it was 60 odd cents, and did I think it would go to $5.60 in the space of a couple of weeks? No, to be really honest. But I do think with those results that have been released now, the platform is there, and the company can sort of turn into probably Australia's largest diagnostic company.
The fact that I didn't buy any at 60 cents would speak to the fact I didn't think it was going to go to $5.60 either, Chappie. But we're not going to harp on it. We're not going to harp on about that. You mentioned valuations there and the comparables with some of the US counterparts. Just about any time I look at an Aussie biotech stock or a stock in that healthcare space with comparables over in the States, the valuations over there just dwarf what the valuations are here. You see some of the companies that Kathy would invest in. They just make the Aussie ones look like ridiculous value. Do you think you'll start to potentially see some US investors look at that potential price arbitrage and go, the valuations here don't really stack up compared to what you can get in Australia? Or do you think there'll be some important implications with that valuation differential?
Look, I agree. I think it's only a matter of time before, there are, like as we've seen with PolyNovo, for instance, that went from when we got involved in that, it was like 5 cents, and it went from a, 25 mil market cap to, to 2.2 or 2.3 billion over a period of time. And it's settled down a little bit now, but I think there's a bit of arbitrage there. There's certainly, Australia is up there in terms of the scientific knowledge and know-how and so on, and the educational standards that we're seeing are consistent with that of the US. I think that, the US market as a whole is just, I don't know, it's just the liquidity is gigantic. If you can sort of crack that US listing in some of these companies, and I think you'll make multi of where it is even at this point in time. And so I wouldn't be surprised if you do see some, but keep in mind, on the US market, a micro cap stock is 350 million US. So, our stocks need to get bigger and bigger and bigger here first, and then in order to just attract some of that money.
Do you think there's a bit of a play, or not a play, but that VC mindset in America, the Silicon Valley mindset to investing? They're investing in stocks that don't necessarily mean revert. Apple hasn't mean reverted. Facebook doesn't mean revert. They're transformational stocks once they get network effects that they can grow exponentially. Whereas as an Aussie investor, a lot of us are spending our days investing in resource companies, which generally by their definition outside of Fortescue mean revert, particularly the base metals. Do you think there's something in that broader psychology that differentiates the markets, or do you think it is just the liquidity that you mentioned?
Oh, look, I think it's both, to be fair. I think there's the liquidity is definitely a factor, because those funds over there are so huge now, and there's so much money obviously in the system sloshing around trying to find a home, and so therefore there is that sort of what you mentioned there is a bit of a paradigm shift going on, and I'm 46 years old, and I'm old enough to remember, and I'm old enough to have been in this game since I was 20, 23, 24, and I'm old enough to remember the tech boom and the tech bust. And I think at that time, the concept of what was happening and what people, the vision that the entrepreneurs had and whatnot, was absolutely 100% correct. We were going to have the Internet of Things and all those buzzwords and whatnot. It's just taken 20 years to play out. And now we're at that sort of saturation point where, look, at the end of the day, thanks to these sort of things, technology is readily available to everybody. Whereas back in the day when I first started in this industry, we were still using the old brick Nokias sort of thing. and we were using a fax machine for bloody contract notes. And so I think now there is that sort of paradigm shift is upon us as a society. And as a result, that liquidity now is just so huge, and it's chasing, whatever. It seems to be flowing, especially in the US. And now you're seeing the invent in the US of the SPACs, and that's creating a whole nother market. And so there's pension funds that invest in those SPACs to get yield, and all the other machinations that are going on. So in terms of that sort of broader question, it's probably beyond my pay grade, but I reckon I reckon there's certainly forces at play now that are a bit more global than there were, say, 20 years ago.
Anytime I see the SPACs in the States, I think of the Perth brokers and their shell companies. They were just ahead of the game by 20 years, weren't they?
If only we could list some cash boxes these days, it'd be great fun.
Well, that's right. The Aussie shells / SPACs have been taken away, haven't they? But
yeah, they have, and it's unfortunate because there is that, and this is where this is a whole nother conversation around the ASX and so on. But it's unfortunate because what the reality of the situation is that no one goes out on the intention to lose money, but sometimes stuff happens that beyond anyone's control. Promoters, directors, companies, whatever, it's beyond anyone's control. And so people naturally, you do have a loss in there. And the old shell game used to allow people to have another go.
That's right.
And now it's a little bit, you just can't do it anymore. And I don't know whether that's I'd really like to see the NSX get up and get liquidity and get really going, because I think that would be a viable alternative to the ASX. And if the NSX got up and got liquidity and really got a lot of companies on there and a lot of companies vested on there with a vested interest in seeing it succeed, I think that would be a great result. And similar to, say, the New York, London has the LSE, and then they have the LSE standard, and then they have the AIM, and I think Australia should develop into that sort of thing, because it does give, it gives companies a second chance at life. Bard One, classic example. Bard One was a mining company about 8 or 9 years ago. Now, all those shareholders that had all the shares in that mining company that didn't actually work, and through no fault of anyone's, it didn't succeed, now are sitting on, big wins in terms of their Bard One stock.
There was, I think there were just some horrible cap structures, weren't there, in terms of the promoter scares. But it's like the ASX said, well, instead of cleaning up that side of it and letting it occur, which there was a lot of things that were great about it for investors, they've just sort of sacked them all together, which I agree. I reckon it's been a shame.
It's a philosophical sort of view, but I don't know why the ASX hasn't done a deal with the NSX and just said, right, we'll own a chunk of your exchange, and for that we'll put 1,000 companies on there or something like that. It gets sort of shifts what is probably the ASX's biggest, I would say it'd be the 80-20 rule. ASX would spend 80% of their time on 20% of their to and I don't know why, but like I said, beyond my pay grade, that one, mate.
But we'll get on to your next stock soon. But to finish up on Bard, I just sort of want to get you to walk through us the psychology of investing in companies that gone up so rapidly. I struggle to invest in a company, even when you talk about its addressable market is big, 300 million market cap is, very reasonable if they end up being successful. When you see companies you want to buy that have already gone up so rapidly, do you try and structure your investment in a staggered approach? Do you try and run the gauntlet and still jump in all at once? How do you sort of view it, generally speaking, from a merchant funds perspective?
I try and structure it a little bit, and I'll give you an example. I try to structure it in a way that I'm always conscious of risk, for number one. So we're always conscious of not sort of paying over the odds if it's hard when something's gone up like Bard has so much. Would I whilst I think it's and we're fortunate because we've been in it, and I think it's a combination of and the reason why it was sort of so undervalued, if you like, and unloved is, it was pretty quiet. There wasn't much marketing. There wasn't much PR or IR information out there. post the merger with Sienna, it was a matter of sort of just doing the nuts and bolts right. The company had to move from Perth to Melbourne. Leanne, the CEO, moved from Perth to Melbourne. We had to restructure the boards. There was changing offices, all of that sort of stuff. And the difficulty with all of that is it happened right in the middle of COVID. And so Leanne essentially moved from Perth, where we were relatively unaffected by COVID, with the exception of a couple of little sort of lockdowns here and there, but to Melbourne. And so she went from having pretty much a free life to do whatever she wanted, and all of a sudden 15 weeks of lockdown. And as you guys all copped over there, which was awful. And so for a fair amount of time post-merger, there was actually just doing the nuts and bolts of the business and slashing costs and, all of those sort of things. So there wasn't a hell of a lot to talk about. The structure of the company now with, Carl Stubbings, Jeff Cummings, Professor Alan Cripps from Griffith University in Queensland, Max Johnson, Philip Powell, the board is pretty, for such a small company, the board was pretty rock star. And so when we sort of look at investments like that, and we look at the board and the people, and then we try and work out, well, how, do DD on the industry. Is the industry gigantic? Is there the opportunity for the company to re-rate? And if there is that opportunity for the company to re-rate and go up dramatically, then how do we get set? And to give you an idea, we're doing a transaction at the moment, which has just been released today, in a company called NTI. And what we're looking at on that one is we're exercising some options in order to get set. We're underwriting some options and we're exercising options, and because we're not getting set enough as what we would naturally want to just via a replacement. And so we look at various structures and strategies in order to get our holdings up at a certain level that it makes a difference. Because for us now, with the sort of volume of funds that we're running, you need to be able to make a difference. There's no point putting $1 million into something if it doubles, because unfortunately it's a first world problem, right? But it doesn't necessarily move the needle in what we need now. So when we're looking at companies, and Bard's a great example, we've got a big position, but I think the market cap of this, I do think we're going to see Bard probably as my personal view is that we'll see Bard as the $1 billion diagnostic company in Australia. And it takes time and it takes patience and it takes capital, and we put the capital in. We've got the right shareholder base now. We've got the right board. Dave Williams is in there with us as well. And I think we'll see more and more opportunities and progress down the track on that one. So
beautiful.
It's a good one.
It's a big call, and it's going to be a great story to continue to watch. So secondly, the second company you wanted to speak about is one I am on the register of, in the interest of transparency, and that's Davenport Resources. Why don't you start with telling us about what they do?
Yeah, well, look, it's a potash company based in Germany. So what I like about Davenport Resources, I do resource deals from time to time. I don't do a hell of a lot. I don't do the scattergun approach. And even though I'm from Perth and I'm in the Wild West, so to speak, and it's the resource capital of Australia, I don't do a gigantic amount of resources deals. But when something comes across my desk, which I think has got the ingredient, what I try and do is I take my views on and my strategies in terms of the biotech to the resources market. And there are some overlaps and there are some similarities in some people probably won't like me saying this, but where you've got a scientist and a geologist, and they're similar types of people, and they're both looking for something, and one of them's looking in a petri dish and the other one's looking in a drill hole or a drill core or something like that. And so there are some overlaps within those industries, and so I try and just take and the reason why I like Davenport, for instance, and specifically, is similar to the Bard one. It's a gigantic project, and it's a gigantic problem. And as the world grows and grows and grows and gets bigger and bigger and has food shortages and all of those sort of things, and we have climate change and we have weather patterns that are unpredictable and those sort of things, then a potash company that that can help, at a basic human level. When I look at, there's some charity stuff that I do with Oz Harvest. If there's a company out there that can, assist people to grow food more effectively on a smaller plot of land, then I'm quite interested in that. And Davenport is probably the largest potash resource in Europe, and it was a company that's been around for years. And so, if I use the scientific analogy, or the analogy I talked about, when I look at these sort of investments, then I look at the company, do the DD on the company, work out the size of the company and where I think it could go to. And then it's a matter of looking down further at the board and the share register and all the other bits and pieces, and just trying to work out, okay, well, I like their size, I like the theme, I like the company, I like the structure of the investment. How do we get set, and how do we get enough stock? And we've only just recently gone, we've been building a position there for the last few months. And only just recently have we sort of gone substantial, and then we topped up again when there was a vendor sell down. So a lot of people will be put off by that. Like when you say vendor sell down, some people in the small cap market go, oh my God, never go near that sort of thing. Whereas I'm looking at it, well, the vendor sell down was actually the opportunity for us to increase the stake. And so from that point of view, when you look at like the science stuff, it's a gigantic company. There's potential for it to be huge. It's based in Germany. As I said, it's the largest sort of potash resource in Europe. Had something like 300 drill holes in the area already drilled back in the sort of early 90s. For various reasons, it was abandoned, and then actually a guy out of Melbourne picked up the assets and put it into a listing, and they listed at 20 cents. Stock didn't do a hell of a lot. We're in now at about sort of our average cost is about 6 or so.
So it's been a working mine before, and like you said, they've got a heap of historical data there. They still need 2 holes to actually become JORC compliant resource, which a lot of people are feeling will give it the potential to re-rate. The fact that they've got over 300 historical drill holes, does that give you some comfort that they're more likely hit on those drill holes than a typical explorer that might be drilling land for the very first time?
Yeah, look, it does, Chris. It gives me a lot of comfort. And this is where looking at the downside, and trying to cover off on the downside risk, is the company where its market cap is now, it doesn't have a huge amount of downside risk. They recently raised about 8. I think they got demand for a fair bit more, and they might have taken a little bit more money, and we participated in that as well. And that money was to do the 2 drill holes. So like you said, they've had around 300 drill holes in the past. And now, look, I think you've just got to back the horse called vested interest a little bit. Everybody's out there now trying to make money for shareholders and trying to, like I said back at the start, everyone's trying to do the right thing, and so logic would say that in order for Davenport to re-rate, that they would go to the lowest hanging fruit in terms of those historical data that they've got. So, in my mind, that's a pretty good bet, that I think they'll re-rate substantially based on the success of those 2 drill holes that they go to.
And so that's one milestone or potential milestone. I think when investors are looking at these types of resource plays, local community support is another thing that would make sense to watch really closely. If you've got a mine and the locals can't stand it, or it's it's uranium or a substance that's sensitive, that community support plays a very big part. Is that something with a company like Davenport that you'd be watching closely to make sure that the company is getting that community support?
Yeah, absolutely. Look, and this is where you sort of have to look at the success of Vulcan recently. So Vulcan, Germany's obviously first world, and they're quite pro mining if you're doing it in the right way. And the success of Vulcan is really testament to that over the last 6 or 8 months. That was a stock that we had some involvement in early on, and unfortunately sold out early on too. But we've still got a few shares kicking around, and that's had a phenomenal run. But I think if you've got the community support and you've got a pro-government, which Davenport does as well, you've got, it's in their best incentive for the community there to get that mine back up and running, because it's not like, and this is where I think some of the ESG movement's coming into play now a little bit, because it's not an open mine. It's not a mine that they're going to have to start from scratch and go, and be very environmentally damaging. This is something that has been open and operational as recent as the early 90s. And through various reasons, mainly like potash price dropped and became uneconomical to continue to do it. And when Germany sort of moved to east and west and so on, then it sort of got left. And whereas now I think the government is certainly pro mining, and from an environmental standpoint, there's less impact by going over those existing holes than there is of starting a brand new mine. And there's a hell of a lot of value in that. If you think about it, there is like those three. With the company's spending $8 million or thereabouts in order to drill 2 holes. Now, they've inherited data for 300 holes. So you just think about the value that's in there, the money that has been poured into that ground, and have a working mine there. So, looking at the risk factor, I'm looking at something like Davenport and going, okay, what's my downside? My downside might be, we invest at 6 cents and it goes to 4. But my upside is we invest in 6 cents and it goes to $1. And for me, managing that equation and having a say, or not having a say, but, having a decent stake in that company, if that goes to $1, then, it means from our point of view, or from the Merchant Opportunities Fund point of view, we'll print good numbers next year as well. And so, those things are really important. But I think, certainly a pro-government, is first stage. And experienced guys on the board and running the company at the end of the day.
And in terms of the thematics that potentially play into Davenport's hands, food inflation is an issue which many think is coming, already starting to see it in different food products and commodities in the last 12 months. If we do see continued food inflation, the amount farmers are going to be able to spend and want to spend on fertiliser to increase their yield is going to go up significantly, one would imagine. So is that part of the thematic, the blue sky thematic, that if food inflation comes, the potash price will follow?
I think so, for sure. I think it's a logical scenario that you're going to see. Unfortunately, that's a world problem, right? And it is a legitimate world problem. And I have had some exposure through being heavily involved in Oz Harvest here in the WA, and that's a food charity. And Oz Harvest has offices in Sydney and Melbourne and everywhere else as well. But I started the Perth sort of chapter of it. And food inflation and food pricing is a real problem. And it's a real social problem when people, have to make a choice between medicine or food. And unfortunately, that is the case in a lot of places. So I agree with you 100%. I think that as food inflation starts to kick in, you are going to see people trying to, grow more on less. And as the world's arable land reduces, and you could sort of attribute that to various factors, but certainly, there's got to be a climate change argument, there's an industrialization argument, all those sort of things. And that's beyond this conversation, but I do think that is something that is going to be an issue down the track. And I also think this is why you're starting to see the potash price increase. 91, 92, early 90s, it just wasn't an issue. Whereas now I think you're starting to see the price of, and all of those factors that I've mentioned a second ago could be at play there. You just don't know, but you are seeing, fundamentally the potash price has risen about 30% in the last couple of years. And I think it will be a theme of the future, just like, clean energy and Vulcan and those sort of companies and whatnot. And so I do think that is something that will play out in certainly in Davenport as well.
And you mentioned ESG briefly before, which is obviously another huge long-term thematic. When I look at Davenport from an ESG perspective, I think having a potash deposit in Central Europe where you can distribute potash to farmers nearby would be a plus from an ESG perspective. But then is there also a movement against these sorts of fertilisers by some of the ESG community? Maybe talk us through, if I've got that right, and how you're viewing those two potential issues.
The ESG community is a difficult one. not a difficult. Not saying the community is a difficult one. I'm just saying that sort of type of investing, I think, is a bit difficult to track, because I think it evolves quite a lot, and it evolves on a daily or a weekly basis. And what's considered, ESG friendly a month ago now is not. And so I don't know if you can sort of put to, but it does have an impact on. Like, I know of a mate of mine who runs a gold company, and they had an incident. They had a lot of ESG funds that were investors in the gold company, and then they had an incident at a mine site, which is an accident, and all of a sudden the share price is down 30% because the ESG funds all bailed. So I think focusing on that too much is sort of a little bit difficult, because, like I said, that tidal wave moves wherever it goes. And
uranium's a bit like that, don't you think? In a minute, uranium feels like it's flipped from being something ESG wouldn't touch even only a few years ago, and that feels like that's quickly sprinting towards golden child of the ESG community. Yeah,
it is. And look, Europe is certainly the biggest, or the biggest. A lot of France and Germany have uranium power plants. Nuclear power plants is how, when you're driving through Germany or you're driving through France and whatnot, there's nuclear power plants all over the place. So you're dead right. 3 or 4 years ago, you couldn't, for love or money, get a uranium deal off the ground. Whereas this year or the last 12 months, uranium is the next, is certainly a hot item up there with lithium and other, metals that have been, are now ESG. So I don't know, mate, to be really honest. It's, I think if you look at ESG and you look at you're talking about the environmental impacts of something like Davenport. Now, all of that, like I said before, all those drill holes have been done. So you're not starting from fresh. It's close to, you're selling potash into European markets. It's the biggest potash ground, or the biggest potash area in Europe, and you're selling into Europe. So therefore, transport costs are going to be lower.
Yeah.
So, there's those sort of things that are all positives. But then, like you correctly said, is that, people are sort of saying, well, fertilizer might not be as ESG friendly as some other method of increasing your output on crops increasing your productivity from a smaller plot of land.
But generally, people that can't afford to eat aren't making those arguments, are they?
Correct. Exactly right. And that's where I think, I think people, for food security is a big issue. And this is, and again, when I talk about Oz Harvest, I don't want to talk, because it's not a conversation about Oz Harvest, but food security is a massive issue, and that's a massive issue worldwide. And I agree with you. I think when people are making that decision, they're not necessarily, focusing on, did those, are they organic apples or are they just apples from wherever?
And so to finish off, maybe just give a broad overview of market cap of Davenport. It's going to be a relatively low CapEx project, we believe. What sort of numbers you feel it's going to take to get the mine back up and running, and if you've done any sort of future cash flows over it? In broad brushstrokes, that'd be a great way to finish.
I think market cap where it is at the moment, I think there's, like I said, I think this is one where there's gigantic upside, and it's a huge addressable market. Market cap is relatively small at this point in time. The company's got the board in place, the right board in place. They've got the right amount of cash in place. They've got the right shareholder list and the right structure. So I think, those sort of tick items for me are really important. And there's something that, potentially, when your investors are looking at sort of how to choose stocks, and some of that information is hard for people to obtain. You can't just get that from going online at the ASX.com sort of thing. And so, from my perspective, those are really important attributes that I look for in a company, along with massive upside. Now, given the history of that particular asset in Germany, given the environmental sort of upside of not having to redo the whole thing, given the community involvement and it's also a perpetual mining license. It doesn't expire.
There's no royalties either, is there? Is that right? Yeah.
And that's really unusual, you know, like it's something that the guys that sort of found that and put that into Davenport as the company originally, you know, that's a huge selling point. And I don't think that's been articulated that well, you know, like a lot of mining deals in Australia or whatnot, or most other, you know, developed nations have an expiry date. You know, this thing's perpetual. And like you said, you know, there's no royalties. So, you know, so the capex is relatively low because a lot of you know the grunt work, if you like, has been done. So, and then when you start to look at other projects in terms of, you know, scale and size, you know, BHP have got some potash projects in Canada now. You know, they've tinned up about $12 billion or something of that nature. You know, so you're talking massive numbers, and I think, you know, Davenport can certainly, you know, drill a couple of holes. I'm hopeful that it's the low-hanging fruit type strategy, which, you know, I'd imagine it will be. And like I said, I think it could re-rate certainly up to, you know, up to $1 in the right market. Not arguably, I think we're in the right market, but I also think, you know, I think even at $1, it'll still be pretty cheap. And then you'll go out and raise money, and it'll still be one of the cheapest potash deals, you know, globally. And I just don't think the market is seeing that upside at the moment. And I don't think the market is seeing the opportunity that is there with that perpetual mining license and no royalties.
Beautiful, Chappy. That's a great overview. So, mate, thanks very much for your time. Really appreciate it. And we'll have to catch up soon when the borders open.
No problems. Thanks, Chris.
This episode of Talk Your Book was proudly brought to you by Honan, who go beyond a transactional insurance broker to deliver better outcomes for their clients. If you're enjoying Talk Your Book, make sure you subscribe to Chris Judd Invest.